Hi, welcome to Christensen Wealth Management. I'm Michael Christensen, and thank you for taking time out of your day to watch this weekly stock market update for the week ending Friday, November 9th, 2018. Before I jump into the charts and commentary, I would like to begin with my quote of the week. And this week's quote is from Zig Ziglar, famous motivational speaker. He once said, "Time well spent results in more money to spend, more money to save, and more time to vacation." Those are some wise words from Zig Ziglar. Well, we have had quite a week. We had the midterm elections on Wednesday and on Tuesday, with the results out Tuesday night, and then all the results on Wednesday, followed by a Federal Reserve announcement on Thursday, in which they stated no desire to stop their interest rate increases throughout the next year, and they did not raise interest rates at this November meeting. So that was the result of that. The stock market has rallied quite significantly since the lows of the last week of October, and what you'll see on the charts is that we are not out of the woods yet. So far, the Dow Jones Industrial Average is still hanging on to its 2.5-year trend line, but the S&P 500 and the NASDAQ Composite both broke their 2016 to 2018 trends and have simply rallied up over the last couple weeks to retest those trend lines from underneath, and now we may be seeing a failure in the S&P and the NASDAQ. So let's go ahead and take a look at that. It'll be a somewhat short video today. I want to keep it brief. I have some things I need to go do, but we'll go ahead and begin with the Dow Jones Industrial Average. Looking at this chart of the Dow Jones Industrial Average, you can see the rally that we had that began on October 29th and took us all the way up here to the day after the midterm elections this week on November 7th. So far on the 9th, which is today, Friday, the Dow Jones has started to turn back down again. If we look at the short-term indicators, the 5-day moving average in red is back above the 20-day moving average in blue, indicating we do have short-term strength because of this strong rally we've had the last couple weeks. And if we look at the intermediate term indicators, the 20-day moving average in blue is still below the 50-day moving average in purple. So we still have confirmation of intermediate term weakness. So still remain to use caution, or still continue using caution, I mean to say, until we get that intermediate term indicator a little higher if it can. Now there's one thing I just wanted to point out, and that's the trend lines that we have on this chart. Let me zoom out to 2016. This is the Dow Jones Industrial Average from January 1st, 2016 until November 2018. And you can see that the trend line began on February 11th, 2016. The trend line made a second point on November 4th, 2016. And most recently, we came down and touched that same line a third time on October 26th, 2018, and then bounced off it. I'll move that over just a little bit. So you can see that those 3 points line up almost perfectly, and we got a nice bounce off of that. But right now, that is a sign of support. The red line is a support line for the Dow Jones, and if that red line is broken, then that takes us back to the 2009 trend line, which I'll show you now. Here's the chart of the Dow Jones Industrial Average going back to the spring of 2009. In fact, the low point right here is March 2nd, 2009. I'll draw those trend lines for you. Here's the one that I just pointed out, and that is this one right here. And that's what we're currently sitting on. I'll change this to a candlestick chart real quick, and then draw those lines back in there. Okay, so that's the one I just mentioned. This is the trend line that is still holding the Dow Jones Industrial Average up. And if that breaks, then the only remaining long-term support is this one down here. and that would be a drop for the Dow Jones Industrial Average from the current price as of the recording of this video, which is 25,970, down to 19,371 approximately, where this bottom red line is. So that would be a 5,000 point drop in the Dow Jones Industrial Average, or a little over 20%. So we'll keep a close eye on this trend line here, the one that we're currently sitting on, and see if it breaks during the month of November. That would be extremely bearish for the Dow Jones Industrial Average. Here is the chart of the S&P 500 stock market index, and you can see that the S&P declined on the 8th of November, and then as of the recording, we're in decline again. So the S&P is currently being rejected by these 3 points. We have this one right here, which was February 26th and March 9th, 2018, as well as this high here, June 12th, 2018, and by this high right here, which is October 16th. So we'll see where we go, but right now that is not a good sign for the S&P 500, and caution should definitely be used. We do have a short-term strength indicator on the S&P 500. You can see that the 5-day moving average in red is back above the blue 20-day moving average, which is a sign of short-term strength. And we still have the 20-day moving average deeply below the 50-day moving average, which is intermediate-term weakness. The trend lines I'd like to show you real fast. We have the 2016 to 2018 trend line, which I will show you right now. This is a chart of the S&P 500 from January 1st, 2016 until today. And if I draw in the trend line, like I said, this is the current trend line that the S&P 500 is following. And you can see that the 2.5-year trend has been broken as of October 2018, meaning the red line has broken. We rallied up one more time, October 16th, touched the line and failed because this red line that was support is now resistance. And as of October 30th, we rallied up one more time, touched that line on November 6th, and have been rejected again. So this opens up the door to more downside for the S&P 500 if this decline continues into the remainder of November. And if I zoom out to 2009, this will be the next possible line of support for the S&P. Take a look. This is the S&P 500 beginning January 1st, 2009. And so here's that red line I just told you about. If the S&P 500 does not succeed in rising back above that line, then the next trend line that we have goes back to 2009 and goes just like this one right here. And so there's a lot of room here between where we are now and that 2009 to 2018 trend line. So much more downside possibility here for the S&P. Use a lot of caution for the remainder of November, because right now this upper red trend line is broken, and we could see a 10 to 15% drop in the S&P 500 just to get down to that lower red line from 2009. Thank you again for watching this market update. Before you go, please do me a favor and click the subscribe button on this YouTube channel, and then click the little bell next to it so you'll be notified whenever additional videos are posted. And in the top right hand corner of christiansenwealth.com and in the summary description of this YouTube video, you will find links to the Facebook, LinkedIn, and Twitter pages for Christensen Wealth Management. Please visit those pages when you have time and like or follow them while you are there. That way I can communicate with you throughout the week on social media. Well, have a great day and a great week. Remember to use caution. We're not out of the woods yet. And remember, getting back to even is not an investment strategy. So protect your hard-earned money and your investments until we get through the crazy volatility. See you again in about another 7 days. Bye-bye.